Most options education teaches you how to enter a trade. Almost none of it teaches you what to do when the trade moves against you. Rolling is the answer most professionals reach for first, and most beginners never learn. Rolling is not closing a position in defeat. It is actively managing a position by closing the current option and simultaneously opening a new one with a different strike, a different expiry, or both, in exchange for additional credit or improved positioning. Done correctly, rolling extends your time, adjusts your strike to a more favorable level, and frequently generates additional premium while doing so. Done incorrectly, rolling is just a way to delay an inevitable loss and make it larger. In this video, I will show you exactly when and how to roll a covered call, a cash-secured put, and a short spread, with real examples on Tiger Brokers so you can make the roll decision with confidence every time your position needs attention. Rolling has two components executed simultaneously as a single spread order. The close leg, you buy back the option you are currently short, closing your existing position. The open leg, you sell a new option with a different expiry, a different strike, or both, establishing a replacement position. The net result of both legs is a credit, a debit, or a scratch, no cash change. For a roll to be worth doing, it must meet one test. You must collect a net credit or at minimum break even. If rolling costs you a net debit, you pay more to close the current option than you receive for the new one. You are paying to delay a loss, not improving your position. This is the most common rolling mistake, paying a debit to roll, believing more time will fix the trade. More time only helps if the new position has enough credit potential left to matter. The credit test is non-negotiable. Roll for a credit or do not roll at all. Rolling a covered call, the most common roll scenario. You sold a 30-day covered call on Apple at the 185 strike for $2.50. Apple has risen to 189, above your strike, with 10 days to expiry. Your covered call is now worth $6.50 in the market. You face potential assignment. The buyer may exercise their right to buy your shares at 185 when the stock is at 189. You miss the $4 rally. You decide to roll. Close the current 185 call by buying it back for $6.50. Open the next 30-day 190 call and collect $4. Net debit, $2.50. You paid $2.50 to roll, but you have shifted your strike from 185 to 190, gaining $5 more of upside if Apple continues higher, and extended your position by 30 days. The roll costs a debit here because Apple has moved significantly in the money. In this case, the roll is justified. You are buying $5 of additional upside exposure for $2.50. Rolling a covered call for a credit, the preferred scenario. You sold a 30-day covered call on Apple at the 195 strike for $1.50. Apple has risen to 188, still below your strike, with 10 days to expiry. The current 195 call is now worth $1. You decide to roll early rather than wait for expiry. Close the 195 call by buying it back for $1. You have already made 50 cents on the trade. Open the next 30-day 195 call and collect $1.75. Net credit from the roll, 75 cents. Total income generated, 50 cents from the first cycle plus 75 cents from the roll equals $1.25 in 2 months, with another 30 days of position life remaining. This is rolling at its best, early in the cycle, before the position is threatened, collecting additional premium while resetting the clock. Roll early when the trade is still working, not after it has turned against you. Rolling a cash-secured put when the stock falls toward your strike. You sold a 30-day cash-secured put on Apple at the 175 strike for $1.80. Apple has fallen to 178, approaching your strike, with 15 days to expiry. The 175 put is now worth $2.50. 3 choices: hold, take assignment, or roll. If you still want to own Apple below 175, taking assignment is valid. You buy at 175, your effective cost after the premium is $173.20. If you do not want to own Apple at 175, you roll. Close the 175 put by buying it back for $2.50. Open the next 30-day 170 put at 170 and collect $1.60. Net debit, 90 cents. You paid 90 cents to move your strike $5 lower and give yourself 30 more days. The stock now needs to fall another $8 below its current price to threaten your new strike. The roll bought you space and time at a modest cost. The roll down and out on a cash-secured put collecting a credit. You sold a 30-day put on Apple at the 180 strike for $2. Apple falls to 177, $3 below your strike, with 15 days to expiry. The 180 put is now worth $4. Option 1. Close for a $2 loss. Option 2. Roll. Close the 180 put for $4. Open the next 45-day 175 put and collect $2.50. Net debit, $1.50. You paid $1.50 to move your strike down $5 and extend by 15 days, from 30 to 45 DTE. Alternatively, open the 45-day 172.50 put and collect $1.60. Net debit, $2.40. You moved $10 lower for $2.40, 3 months of original premium recaptured in the roll. The key question for every put roll is, do you still want to own this stock at the new lower strike? If yes, roll. If no, close and move on. Rolling a put you are not prepared to be assigned on is the most dangerous version of hoping a trade repairs itself. Rolling an iron condor when one side is threatened. You entered an iron condor on Apple with short strikes at 175 and 190. Apple has rallied to 189, approaching the 190 short call. The iron condor is under pressure on the call side. You can roll the call side up, buy back the 190 call, and sell the next expiry 195 call for a net credit. This gives the call side more room and more time. Alternatively, roll the entire iron condor. Close all 4 legs and re-enter at new strikes centered on the current price. The full roll costs more in commissions but resets the position to a neutral stance. The rule for iron condor rolls. Only roll the threatened side if you are confident the other side will not become threatened by the same move. If Apple has been trending strongly upward, rolling only the call side, while leaving the put side alone creates a lopsided position. Your short call is now at 195 while your short put is still at 175, meaning the full tent has shifted without adequate room on the downside. On Tiger Brokers, a roll is executed as a single spread order, close and open in one ticket to eliminate execution risk. Navigate to your open positions. Select the covered call or put you wish to roll. Use the roll order function to automatically populate the close leg with your current short option. Then configure the open leg. Select the new expiry, enter the new strike, and specify whether you want to collect a net credit or pay a net debit. Tiger displays the net credit or debit from the combined transaction in real time as you adjust the new leg parameters. Always enter roll orders as limit orders at the net credit or debit you are targeting. A market order on a 2-legged roll can result in significant slippage. The bid-ask spread on each leg compounds when executed simultaneously. Enter your target credit. Work it for 5 to 10 minutes around mid-price, and adjust by a few cents if needed to get filled. The rolling decision framework. Ask these 4 questions before rolling any position. 1. Does the new position still have a valid trade thesis? If the stock has broken a key support level or the fundamental reason for the trade has changed, rolling is not fixing the trade. It is adding time to a broken idea. 2. Can I collect a net credit from the roll, or at minimum break even? If rolling requires paying a net debit, the only justification is buying additional meaningful strike improvement. 3. What is the effective cost of the roll in annual terms? Paying 90 cents to gain 15 more days of time and $5 of strike improvement is equivalent to paying $22 per year to own that improvement. Evaluate whether that cost makes sense. 4. Am I rolling to avoid taking assignment on a position I no longer want? If you are rolling a put repeatedly to avoid owning shares you do not want, stop rolling and close the trade. Rolling is a management tool, not a mechanism for avoiding a decision. When not to roll, the 3 situations where closing is correct. 1. The stock has broken through both strikes of an iron condor or has fallen well below a put strike, and there is no realistic probability of recovery within a reasonable time frame. Rolling deeper and further out only enlarges the eventual loss. 2. The credit available from the roll is too small to justify the additional time at risk. If you can only collect 15 cents to roll a covered call 30 days forward, you are accepting 30 more days of risk for $15 per contract. That is not a favorable trade. 3. The rolling cost has exceeded the original premium collected. If you collected $2 when you opened the trade and have already spent $1.50 buying it back partially, rolling again at a net debit means you have now paid more than you originally received. The trade is net negative regardless of outcome. Close it, accept the loss, and redeploy capital into a new position with a fresh thesis and a clear maximum risk. Rolling covered calls through assignment, the most powerful use of rolling. Your Apple covered call at the 185 strike has been exercised. You are assigned. Your shares are called away at 185. Apple is now at 192. You receive the 185 strike price for your shares plus the original 250 premium, effectively selling at 187.50. Apple is now 750 above your effective exit price. You have two paths. Accept the outcome. 187.50 effective sale price was your target. The trade worked as designed. Roll the position. Sell a cash secured put at 190 to re-enter the stock position and restart the wheel cycle at a higher level. By selling the 190 put, you are prepared to buy Apple back at 190, above where you sold it, but you collect $2 in premium, making your effective by price 188. You are back in the wheel at a higher price point with premium income collected throughout. This is the wheel strategy operating with active rolling management. Rolling versus closing, the psychology trap. Many traders roll positions because they cannot psychologically accept a loss. Rolling feels like doing something, taking action, staying in the trade, giving it more time. Closing feels like admitting defeat. This psychological bias is the most dangerous driver of rolling decisions. A roll must be justified by the numbers, the credit received, the strike improvement, the remaining validity of the trade thesis, not by the desire to avoid booking a loss. Every roll that extends a losing position adds more capital at risk and more time in a position that the market has already told you is wrong. The discipline to close a losing trade cleanly, book the loss at the original maximum defined risk, and immediately deploy that capital into a new position with a fresh edge is what separates consistently profitable options traders from those who accumulate large, unrealized losses in rolled positions they refuse to close. The roll as income amplification, using rolls when positions are working. Rolling is not only a defensive tool. When a trade is working well, rolling forward early, before expiry, can amplify total income from a position. You sold a covered call at 190 for 150 with 30 days to expiry. After 15 days, Apple has not moved and the call is now worth 40 cents. You have already captured 110 of the 150 in theta decay. You can close for 40 cents profit and immediately sell the next 30-day 190 call for 175. Net credit from the roll, 135. Added to the 110 already captured. Total income is 245 in 30 days from a position that would have only generated 150 if held to expiry. Rolling early when a position is profitable resets the theta decay clock and accelerates income, a technique used by professional covered call writers to generate 15 to 20% more annual income than simply holding each cycle to expiry. Complete rolling reference on one page. Roll covered call when stock rises above strike near expiry. Roll up and out to a higher strike and later expiry. Target, net credit or small debit justified by strike improvement. Roll cash secured, put when stock falls toward or below put strike. Roll down and out to a lower strike and later expiry. Target, net credit preferred, small debit only if strike improvement is significant. Roll iron condor when one side is threatened. Roll the threatened spread further out of the money and further in time. Target, net credit from the threatened side roll. Credit test, always non-negotiable. If the roll cannot be done for a credit or scratch, close instead. Early roll for income. Roll at 50 to 70% of maximum profit to reset theta and collect a new cycle of premium. Do not roll when the trade thesis is broken, when the credit available is less than 15 cents, or when rolling is being used to avoid booking a defined loss. Tiger Brokers roll order. Single ticket, limit order at net credit. Work mid-price for 5 to 10 minutes before adjusting. Here is what you now know. 1. Rolling closes your current option and opens a new one at a different strike or expiry, or both, in a single simultaneous order. 2. The credit test is non-negotiable. Only roll if you can collect a net credit or at minimum break even. Paying a debit to roll is almost always a mistake driven by psychology rather than analysis. 3. Roll covered calls up and out when the stock rises above your strike. Roll cash secured puts down and out when the stock falls toward your strike. Roll iron condor sides out when a short strike is threatened. 4. Rolling early when a position is already profitable accelerates income by resetting the theta clock before the final slow decay of the last few days. 5. Rolling is a management tool, not a mechanism for avoiding losses. If the trade thesis is broken, close and redeploy. Series 2 concludes with the skill that separates profitable traders from everyone else, adjusting and managing losing trades from entry through resolution, video 20.